Presented by Levelz Realty, Florida Broker Exam, 2025. Financing. Basics Practice Questions. This document provides a set of practice questions focused on the AX Financing Basics section of the Florida Real Estate Broker Exam. Use these to test your knowledge of key concepts, like mortgages, clauses, and loan types. Question 1. A mortgage clause that requires the lender to execute a satisfaction of mortgage when the loan has been paid in full is called the A. Acceleration Clause, B. Defeasance Clause, C. Due on Sale Clause, D. Prepayment Penalty Clause, and the correct answer is B. Defeasance Clause. Explanation. The defeasance clause provides that the lender mortgagee must release the lien on the property once the debt has been fully paid by the borrower mortgager. This is a legal requirement to defeat the mortgage lien. The acceleration clause makes the entire loan balance due upon default. A due on sale clause, also known as an alienation clause, allows the lender to demand the loan be paid in full if the property is sold. A prepayment penalty clause charges a fee for paying off the loan early. Question 2. Which of the following statements is true regarding a conventional loan in Florida? A. It is insured by a government agency such as the FHA or VA. B. The down payment is always 20% or more to avoid private mortgage insurance (PMI). C. It is a loan that does not have government backing and generally requires a higher credit score. D. The interest rate is always fixed for the life of the loan, and the correct answer is C. It is a loan that does not have government backing and generally requires a higher credit score. Explanation. Conventional loans are not government insured. They are the most common type of mortgage and are based on the borrower's creditworthiness and the value of the property. While a 20% down payment is common to avoid PMI, it is not always required. A conventional loans can be either fixed rate or adjustable rate. Question 3. An adjustable rate mortgage arm is a loan where the interest rate, A, remains constant for the entire life of the loan. B, is adjusted at a predetermined time and frequency, based on a specific economic index. C, is set by the Federal Reserve and cannot change. D, is determined by the lender's discretion at any time. And the correct answer is B, is adjusted at a predetermined time and frequency, based on a specific economic index. Explanation. An ARM's interest rate fluctuates based on a benchmark index, such as the Secured Overnight Financing Rate, SOFR, or the Consumer Price Index, CPI, plus a margin. The adjustment frequency is set in the loan agreement. For example, a 5/1 ARM adjusts every year after the initial 5-year fixed period. The rate is not constant, nor is it set by the Federal Reserve or the lender's arbitrary discretion. Question 4. A mortgage clause that allows a lender to demand the entire loan balance be paid immediately upon the borrower's default is the A. Subordination Clause, B. Release Clause, C. Acceleration Clause, D. Exculpatory Clause, and the correct answer is C. Acceleration Clause. Explanation. The acceleration clause is a standard provision in a mortgage that gives the lender the right to accelerate the due date of the entire remaining principal balance and all accrued interest if the borrower defaults on the loan. The subordination clause allows a future loan to take a superior lien position. A release clause allows the release of a specific part of a property from the mortgage lien upon a partial repayment. An exculpatory clause is used to limit a borrower's personal liability. Question 5. Which of the following is a government-backed loan program specifically for veterans, active duty service members, and eligible surviving spouses that often requires no down payment? A. FHA loan. B. Conventional loan. C. VA loan. D. USDA loan. And the correct answer is C. VA loan. Explanation. The Department of Veterans Affairs, VA, guarantees loans for eligible veterans and military personnel. A key feature is the option for a zero down payment purchase and no private mortgage insurance. FHA loans are insured by the Federal Housing Administration and do require a down payment, while USDA loans are for rural properties. Conventional loans are not government-backed. Question 6. The Real Estate Settlement Procedures Act, RESPA, was enacted to A. Limit the number of loans a buyer can obtain. B. Protect consumers from abusive practices in the real estate settlement process. C. Set a maximum interest rate that lenders can charge. D. Ensure all loans have a fixed interest rate. And the correct answer is B. Protect consumers from abusive practices in the real estate settlement process. Explanation. RESPA is a federal law. Designed to protect consumers by requiring lenders to provide borrowers with timely disclosures about the nature and costs of the real estate settlement process. It prohibits kickbacks and unearned fees. It does not regulate the number of loans, set interest rate caps, or mandate fixed rates. Question 7. What is the primary purpose of a subordination clause in a mortgage? A. It allows a borrower to pay off the loan early without a penalty. B. It permits a lender to declare the entire loan balance due and payable upon default. C. It allows a junior lien to take priority over a senior lien. D. It exempts the borrower from personal liability for the loan. And the correct answer is C. It allows a junior lien to take priority over a senior lien. Explanation. A subordination clause is an agreement that allows a loan with a lower priority lien to assume a higher priority, typically used in situations with a first and second mortgage on the same property. This clause is a common feature in blanket mortgages and ground leases. Question 8. A buyer obtains a mortgage where the lender makes payments to the buyer based on the accumulated equity in the property. This type of loan is known as A. Purchase money mortgage, B. Blanket mortgage, C. Reverse mortgage, D. Budget mortgage. And the correct answer is C. Reverse mortgage. Explanation. In a reverse mortgage, the lender pays the homeowner in a lump sum, monthly payments, or a line of credit. The loan does not need to be repaid until the borrower moves out, sells the property, or dies. This type of loan is typically for homeowners who are at least 62 years of age. A purchase money mortgage is used to finance the purchase of a property. A blanket mortgage covers more than one parcel of land. A budget mortgage includes principal, interest, taxes, and insurance (PITI) in the monthly payment. Question 9. A legal instrument that pledges a property as security for a debt without giving up possession of the property is also known as A. Deed, B. Promissory note, C. Mortgage, D. Lis pendens. And the correct answer is C. Mortgage. Explanation. A mortgage is the legal document that pledges the property as collateral for the loan. The borrower holds legal title to the property while the mortgage is in force. The promissory note is the promise to repay the debt, but it does not pledge the property. A deed is used to transfer ownership, and a lis pendens is a public notice that a legal action affecting a property has been filed. Question 10. The borrower in a mortgage is called the A. Mortgager, B. Mortgagee, C. Grantor, D. Beneficiary. And the correct answer is A. Mortgager. Explanation. The mortgager is the borrower who gives the mortgage to the lender as security for the loan. The mortgagee is the lender who receives the mortgage. The grantor is a person who transfers ownership of property. And the beneficiary is the person for whom a trust is created. Question 11. A loan with a repayment schedule that includes low, often interest-only payments for a fixed period, followed by a very large, lump sum payment of the remaining principal at the end, is known as A. Graduated payment mortgage, B. Balloon mortgage, C. Amortized mortgage, D. Reverse mortgage. And the correct answer is B. Balloon mortgage. Explanation. A balloon mortgage is characterized by a large final payment, or balloon, that is substantially larger than the previous payments. The smaller initial payments can make the loan more affordable in the short term, but the borrower must be prepared to pay off the remaining balance in full at the end of the term, often by refinancing. These review questions were brought to you by Levelz Realty. Please like and subscribe for more helpful Florida real estate broker exam resources and tools. Thank you.